Our next panel discussion, or panel I should say, is going to be led by Albert Liu. You all know Albert. He is the president of Luma Financial, but he's also a co-founder of the Rule Classroom. Great panelists for you this afternoon. They're going to be looking at the macro issues facing us today. I'm going to let Albert introduce the speakers to you. I think we have them all there, do we? Yes, we do. All right, ladies and gentlemen, please welcome back Albert Liu to take you through the final panel session of today. Albert.
Okay, thank you very much, Carrie. I think I'm meant to sit here because this is facing. So let's start by welcoming Adrian Day of Adrian Day Asset Management. Nomi Prins is the founder of Prins Sites and a prolific author. And Grant Williams, who you all know, things that make you go, Adam Taggart will be joining us as well, but I noticed he's just completing an interview outside. So we'll, oh, there he is. Welcome, Adam. All right, guys, welcome. So I'm very privileged to be moderating this panel. It's quite a wealth of knowledge, a breadth of knowledge we have on this panel. It's kind of a shame that we have to sort of constrain the conversation to investing, but that is our task here. We're going to be talking about the macro issues. Guys, I enjoyed seeing you every year. Just to start, guys, in case any of the other speakers are contemplating requesting a tip after their talk, I'm going to show you what I've received so far after my talk. I got a, this is a 50 million note of Venezuela, the Bolivarian Republic of Venezuela, 50 million bolivars, and then this one is, let's see, 20 billion from the Bank of Zimbabwe. So think twice before you ask a bunch of wise guys in the hard money community for a tip. This is what you might get. All right, guys. Okay, so, you know, macro panels are always very interesting. Sometimes it's hard to derive any sort of actionable investment tips from a macro panel. And so I thought I'd flip it around a little bit this year. And instead of asking our panelists what to do, I'd use a trick that Charlie Munger liked to use. And he was the right-hand man of Warren Buffett for many, many years, as probably many of you know. He used a trick he called inversion. And that is flip the problem around. So instead of asking, what should we do to succeed? He would ask, what should we do if we wanted to fail? Or what could we do that would absolutely guarantee failure? So, in the sense of in the sense of the macro environment, I want to ask each of our panelists what they think we should do, or what could we do that would guarantee failure, so that we can avoid that. And so I'll start on my left with Grant. Grant, what are your thoughts on that?
Great question. I've got two for you. The first one is something I've spoken about at this conference before, and that is the danger of confusing the idea of being an investor with being a trader. I think a lot of people make this mistake, and I think it's a guaranteed way to fail. If people like to think, and if you ask people here to tell you what they're doing, they're all investors. But the reality is, if you actually look at how people operate, a lot of them are traders, and there's nothing wrong with being either. The danger comes with wanting to be an investor because it kind of sounds cooler, whereas a trader sounds a bit more it sounds like there's a bit more fortune involved. That's not the case, trust me, but people outside will think that. And I think if you want to call yourself an investor, but the way you operate is being a trader, or vice versa, you're setting yourself up for some serious problems because they're very, very different disciplines. And if you're an investor, there are really two prices that matter to you. The price you buy at and the price you sell at. And the thousands, hundreds of thousands of prices between those two are all traps. They're all traps. Now, it doesn't not to say you don't have to recheck and recheck and recheck your investment thesis for owning the stake that you bought in that particular company, but the two prices that matter to you are only the price you buy and the price you sell. So that's the first one. The second one, I would say, is you have to be very careful, and this is going to get harder and harder and harder and that is outsourcing. Because a lot of people will outsource their due diligence, and AI is only going to make that easier, and it's only going to make it more dangerous. You know, putting in the legwork to come to a conference like this and to sit out there and speak to these phenomenal company builders and actually do the legwork is what you have to do. Sitting at home and typing into ChatGPT, which junior miner should I buy, is an incredibly dangerous thing to do. But a lot of people are going to get sucked into that. And someone's going to tell them, hey, I bought this great stock. ChatGPT told me, Claude told me which stocks I should buy, and I've been making some great money. It's really dangerous. I'll just tell you a quick story. Some friends of mine were telling me that, you know, you should use AI in your process. And I'm like, I don't want to use AI. Not when I'm writing in my creative process, I really don't want to use AI. It just doesn't feel right. And I want it to be my thoughts and not some computer's thoughts. So I did an experiment. I was sitting down to write a letter a couple of months ago, and I took the kind of brief that I'd given myself, like the story arc and what I wanted to say and the things I wanted to include, and I fed that into, I think it was Claude, and said, right, go away and write me 9,000 words. Here's the structure of the story. These are the points I want to make. This is the angle I'm coming at. These are the things I want you to investigate. Away you go. And I just turned it on and left it. And then I spent, the next 4 days writing it myself, researching it, writing it. And when I finished mine and I was happy with it, I went to Claude and I opened the thing that it produced and I wanted to read them, compare them side by side. And I read this through and I'm like, well, this is interesting. There's a few bits in there I didn't know about, and it's taken a different tack on this, and wow, that's interesting. And there were probably 4 or 5 points that I thought, I didn't know that. That should be in my piece as well. So I went in and I fact-checked them, and every single one of them was wrong. Every one of them. And the scary thing was, it had literally, because I asked for attributions in the footnotes, and it had literally made up the names of scientific papers. I wish I was making this up, I swear to God. These highfalutin titles of some scientific paper by Professor so-and-so, attributed in the footnotes, and you go in and check these things, it's like, yeah, I kind of made that up. And this is really dangerous because we all love to make things simple. And I get it, right? The whole history of human progress is because we're essentially lazy, right? We want to do less work and want to make our lives easier. Everything we've invented is geared towards that. This is going to be really dangerous because instead of doing this and paying some money and coming here and getting on a plane and staying in a hotel and talking to strangers, we're going to be tempted to outsource all this stuff. And I think that is going to be a sure way to, if not fail, then certainly not maximize your opportunities to make money. So there's 2 for you, Albert.
2 very good ones, Grant. And you notice that with these, AI utilities, the applications, right on the bottom, it says, your answer is generated by AI, may not be correct. I mean, they might as well say this is probably wrong, which is what they admit after interrogation, right? That the answer is probably wrong, it's probably fabricated, and it's not worthy of trust. Grant, there's a couple things there. I want to tie it, I guess, into the macro environment. You say trader versus investor. Rick likes to sort of poke fun of investors that worry about holding a stock over the weekend. That's like too long for them. One of the ones that I came up with is in this environment, this geopolitical environment where there are multiple wars, trading off headlines is very dangerous. And that's one way you can get really sucked into bad decisions. So I want to ask our other 3 panelists, you want to chime in on any of those, what we just talked about? Nomi.
Yeah, and I touched on this a little bit this morning for whoever came to my talk, that headlines are not only dangerous, and now they're amplified by AI. So you're basically accelerating this feedback loop of a bad headline that then is incorporated by AI, then that's basically adapted from some like junior writer on some other platform as fact, and ultimately picked up by AI-driven trading models that incorporate what the headlines say into how things are traded, that then go into programmatic trading, which then create flow, which then go back to a new bad headline. And so that's another reason why, and ties into what Grant was saying in the beginning, you really have to look at both being an investor instead of being a short-term trader if you want to make real money and not necessarily bet against the headlines, and also ignore the headlines and look at, do the legwork for the underlying facts, the structural supply and demand relationships, the experience of the team that's running the mining company in which you're investing, and that is something that you don't get from headlines. That's like the anti-headline. So that the Charles Munger of the headline situation, that's what that is. And it's super important to make money and also be confident in your investments. It's one thing to want to make money. It's another thing to feel and know and learn why you invested in something and to continue to go back to that. So you're also not swayed by the headlines or by the short-term market volatility that is generated from those headlines.
I would also add, when we're talking about headlines, I would add a pretty obvious couple of things. One is, as Grant alluded to, or was it Nomi? I've forgotten already. Memory's the second thing to go.
And you forget the first?
Well, in my case, it's my knee joint. So, you know, a lot of the articles, even in the Wall Street Journal and even in the New York Times and good magazines, are written by junior writers. They're not written by, you know, experts in the investment field who still get it wrong, of course, but they're not written by people who even purport to be experts. Don't forget that by the time you read the front page headline in the Wall Street Journal, the prices are already reflecting it. I can't tell you how many times people have said to me, oh, I read this article in the Wall Street Journal yesterday. It was on the front page. Well, don't you think everybody in the investment business already knows it by then? So that's a really important thing.
I'd just say I'm suddenly feeling very unprepared for this discussion, because when you asked us to put together a list of things that people shouldn't do, well, I asked AI, and now I'm not sure my answers are going to be any good. They might all be hallucinations.
Which is a real shame, because Adam did the most work on this project. Okay, so should we move off this? Or actually, I want to interject something here, because Grant mentioned a sort of AI-generated investment thesis, which is very troubling, because even if AI could generate you know, a worthy investment thesis, I mean, would it really give it to you? I mean, does AI really work for you? Is that what you think?
Can I just interject for a second? Because a gentleman came up to me yesterday and told me he's a huge Rick Rule fan. And he said, I talk to Rick every day. And I said, really? Rick's a pretty busy guy. And he said, there's so much Rick Rule content out there that I have trained my AI to consume all of it. And then I ask it questions and it responds to me as Rick. And you know, he said
some of that content is actually generated by Rick.
Pardon me?
I said some of that is actually generated.
It's actually generated by Rick. But the point being is, you know, he felt like it was pretty accurate. But to your point, is it?
No, it's not. Look, you can flood the internet with anything you want, and the AIs will just pick it up as fact.
There's only one Rick Rule. We all know that.
Okay, who wants to go next? Maybe Nomi? Do you have something you want to?
Well, I just want to add in terms of what you shouldn't do, which is you shouldn't, aside from the headlines, aside from AI and not doing your own homework, you shouldn't be comfortable with the pool of commodities you already know and the companies in which you already invested. In other words, if you are in sort of the middle junior mining companies, it behooves you to learn more about the junior explorers and to basically go down the curve in terms of commodity development, and also just to not think that you're only able to invest in gold and silver or even copper or uranium, but to move into antimony or to move into tungsten or to move into soda ash, which I just learned about today in Scott Melby's UEC presentation at lunch. And that was the thing I took the photo of. It was a great presentation, but the point is, what's the thing I don't know? What's the thing I'm less familiar with? And even if it's one commodity or one company that you've never heard of, to really go, not to ignore it, not to sort of reduce your time on it, but to actually learn about what you can invest in that you don't know about, and not to be comfortable with the same assets or even the same companies that you do know. And to even take that risk, even have a teeny little bit of capital set aside, which is also your time capital as well as your money capital, to actually do that and not to remain comfortable with what you're familiar with.
Guys, what are your thoughts on over-concentration? So I'll go to Adrian. Investing in, limiting yourself to a certain commodity, limiting yourself to a certain region. Is that a mistake?
I'll take a slightly different view. I think it can be very, very dangerous. We're talking about how to fail. Very, very dangerous to think that you're an expert after a little bit of research. A little knowledge is a dangerous thing. So while I agree with you, it's a good idea to sort of expand one's knowledge base for a lot of reasons. I think it's good to invest in what you know and what you understand. I will say that for me, over more than 50 years, I have lost the largest amounts of money for myself, not for clients. I made all my mistakes before I hired clients. My biggest losses have always come from when I didn't really know what I was investing in. I'd done a little bit of research, it sounded good, or I heard a presentation and wow, that sounds really exciting. So whatever we're doing, positives or negatives, I forget what we're doing now, but I guess failure would come from not knowing what you're investing in. And there's there's a really important thing that comes from, there's a really important thing that comes from not knowing what you're investing in well enough. And that is that you really don't know how to react to developments of the company that are negative or to stock price moves. You don't know. In my case, I'll say, let's say Agnico or Franco. I think I know those companies so well, but when there's a rock problem at the Barnett, which is a part of a Malartic, I very quickly can see how much they're going to lose and whether that, in ounces in production, and whether that really matters to Agnico or not. If I don't know the company well enough, I say, oh my gosh, they've just had a rock formation problem of one of their mines at Malartic. Oh my gosh, their production's going to go down. And, you're likely to panic. So I think knowing what you invest in is really the most important thing.
All right. Adam, you want to add something to that or sort of pivot into a new direction?
How about I do both? So I agree with Adrian said. I actually thought, Grant, just from having talked to you in the past, that you were going to bring up diversification. Being diversified. Don't be too concentrated to the spirit of your question, Alan, right? You were saying, should we go with the Carnegie approach of just having one basket and watching it super closely? In a market, in an uncertain future as we face right now, there are too many potentialities that you want to make sure that you've got some real diversification in your portfolio. And Grant, you talk about this all the time. True diversification. A lot of people think, well, I'm in this sector and I'm in that sector and whatever. But you're still in equities, right? Mm-hmm. Really trying to find true non-correlated assets and building some real structural diversification in your portfolio is something that actually I think too few investors do in general, but I think even people who think they do it are doing it incorrectly.
Can I add something to that, Adam? Because I think it's a great point, but you said an important thing, which is uncorrelated. And I think people need to differentiate between diversified and uncorrelated. Mm-hmm. They're very important distinctions to make. Some people think, well, if I have 10 different junior miners, I'm diversified.
Right.
Right. And it's a common mistake to make. Being diversified for the sake of being diversified, I can't just have one stock, I need 6. So I need to go and buy 5 others, is a really dangerous thing. And it comes back to what you were saying, Adrian. Whatever it is you're going to either try and learn or understand, or whichever companies is, you have to have genuine curiosity about this. It can't be a chore. You can't think, geez, I really need to stay on top of this thing, because companies aren't door numbers. They constantly move, they constantly change, and you have to want to stay current in this stuff, because if you don't stay current, you're behind. If you're behind, you're going to lose. And so it has to be a labor of love. It has to be something that you wake up in the morning excited to find out what's going on. You're excited to test the knowledge you have. And you're not frightened of change. You're not frightened of bad news, to your point, Adrian, because sometimes bad news can be a phenomenal opportunity, right? If it's the right kind of bad news that everyone else thinks is terrible, to your point earlier on, these are fantastic opportunities, but you have to really understand what it is you have. And that understanding, I believe, only comes from a genuine hunger and a curiosity to understand it, properly understand it.
And just to, I agree with all that, just to put another element on it is, a lot of people invest, say, in hard assets, right, as a way to diversify or in their minds try to escape the general market risk. And I think that's a good approach, but it's not, they're not two closed systems. They still interact with each other. And if we have a large-scale general market correction, it may very well spill into the hard asset space. And you may actually end up doing a lot better than general investors on a relative basis, but understand you still may be actually losing money, at least in the near term of this. And one of the reasons I want to bring this up is, when on my list was, don't assume that past performance equals future performance, which the market is entirely doing right now on the AI complex, right? If you look at the analyst earnings estimates right now, they are accelerating as we go into 2026, future earnings estimates, right? And I think it's very dangerous for a number of reasons, but that's largely based on the current projections of AI capex spending. And right now, the analysts are valuing all this by their Excel models and saying, "Oh, if the cash is there, we think that this many data centers can be built out in the future." And I think they're actually probably correct. The cash will be there to build out those data centers. What I think they are missing right now, though, is there's a lot of real-world physics constraints that I think may prevent that data center build-out from happening on the same pace that the Excel spreadsheet imagines that it's going to. Lack of permitted land, lack of water, lack of capacitors, lack of copper to build these things out, lack of public support, which is something we're seeing increasingly in the news these days. I live in Reno, Nevada, which has been a very data center friendly location. We've got NVIDIA out there. We've got Tesla Gigafactory. We have now passed a moratorium on future data centers right now. If we're doing it, the rest of the country is definitely going to be doing more of it. So, I still believe that CapEx build-out is going to happen, but it is probably likely to happen at a slower rate right now than the magic models are predicting, because they just assume that the cash is there, the data center is going to get built. I think the cash will be there. I just don't think necessarily all of these inputs are going to be there. So if the curve comes down, that delta, that's going to have to be a pretty sizable downward repricing in the market. Should that happen, it's going to pull kind of everything down with it, just given the fact that this is such a massive percent of the market cap of the stock market at this point in time. So anyways, yes, you want to try to find ways to diversify against that risk, but know that that's probably going to spill over into a lot of things in the near term. Now, the good news for hard assets investors is I think those data centers are going to get built out, and it's going to need a ton of real world assets, hard assets, that the market is probably not fairly valuing right now. So I think in the long run, you're all going to be great as hard asset investors, but just be aware of these connections and these limitations. And one last story. So this past weekend was the 4th of July, and I'm not sure how it happened, but a guy who follows Thoughtful Money, who is a very successful hedge funder, now runs his own family office, invited me to a party that he was going to on the shore of Lake Tahoe. And this was the top of the top. Sergey Brin was there. It was that type of crowd of just Silicon Valley royalty, basically. And I was getting to know people, and nobody knew who I was, which was fun, because if they don't know who you are, they have to assume you're important and treat you really nicely. But the people were great, and these were all people who had made, just ferocious fortunes in tech. And when they found out what I did, they were all really interested to hear my outlook for the NASDAQ. And as I started walking them through those concerns I just shared with you, most of them interrupted me halfway through and said, "Oh my God, I feel the same way. In fact, I've sold all my holdings. I'm 65% in T-bills." So if you're watching this party rage on right now in AI and assuming that the captains of the tech industry are all in on it, personally, they are not.
So I think this also goes back to the idea of not blindly, obviously, following a whim, and doing the homework and doing the investment education, and also expanding your knowledge of hard assets, but also what else is going on around them. So certain things have moved in the market because of the strait having been closed. Yes, oil did. Yes, gold did. There's some things that are obvious that are in headlines, that are in stories. Then there's things like aluminum, which has had a massive run. And it's not just aluminum, the hard asset. It's aluminum, the smeltering companies, the infrastructure companies that have to operate regardless of whether AI data centers come in as planned and on time or grow even more than we can imagine. And those are the types of companies that tend to be in the backdrop of what's interesting. It's boring to think of the aluminum that makes your soda can, but if you can't produce the soda can, or if you can't get the aluminum processed through the strait, which nobody was talking about, it's going to squeeze prices all the way down the supply chain. And so I think it's really important. This is a positive, and don't ignore all of the different points of geopolitics, macroeconomics, all the things that are impacting what you have in your hand or what you have in your phone, because there's a lot of value up and down the chain that are beyond the price of uranium or the price of copper that impact how your investments can be diversified.
Can I just piggyback on that really quickly? So when I was at business school, there was a class that we were all forced to take that we all hated. We were super frustrated that we had to take this class, and I can't remember the exact title of it, but the informal name of it was non-markets. And it was basically regulation and all the things that can impact the market, but that aren't natural market forces. And as young, hungry capitalists, we were like, why are we wasting our time with this? We just want to be learning about capitalism and free markets the way they're supposed to work. Turns out that non-markets class was the single most important class we took in business school. When you consider how government and central planners have basically shaped the course of the past 25 years. And so, in this environment, don't just take, okay, well, if this happens in the market, then natural forces will make this the next likely outcome here. We are in a world, especially now in a Trump administration, where the government is increasingly putting its finger on industry scale to try to help certain industries and maybe steal from some other ones to feed the ones that it sees are more important to our national security. And going back to this party I was at, one of the guys I met there was a mining CEO. And his mine produces a lot of antimony. And the government has determined that that's super important these days. And the government is basically rushing him to strike a deal where they can give him a loan to be able to increase that antimony production, because they've just deemed it so important to national security. It's totally changed the focus of his business. And he didn't even see it coming a year ago. So there's a lot of factors like that where I think you just want to be asking yourself, what role is the government playing here? And what is the government likely to do? Because that is actually going to impact the natural free outcome of things. Yeah, exactly.
All right, we got about 10 minutes left, so I want to do something different, and let's talk about a hypothetical, which I don't know how useful it'll be, but it'll be really fun, I think. In Rick Rule's opening address, he used the word orgy to describe something, and so since that's like in play, I've been dying to like work it in somewhere, and I haven't been able to do it until now. But what Adam is talking about is a projected orgy of capex spending, and basically what you're saying is that may either have to be modified or paused or happen at a slower rate. There are a lot of things that could
might be a twosome rather than a threesome, but yeah, exactly.
There are a lot of things that could cause that. I mean, like a revolt by the stockholders, for example. I mean, you look at Meta and whatnot. Shareholders are not happy about the amount of money that some of these companies are spending. You could have a credit event, interest rate spike. A lot of things could do that. So why don't we just walk through what that might look like? And then eventually follow that down to what that means for natural resource companies, if that were to happen, and the underlying commodities. So let's start with maybe Nomi and or Grant. What could trigger something like that to happen?
Yeah, I mean, first of all, the fact that governments and government spending, and it's not just the United States, I mean, throughout the world, they're notoriously fickle, right? So what can happen is it can be antimony today and it can be rare earths tomorrow and it could be uranium the next day. And it literally has to do with two things. One is how are you going to get reelected? And big side part. And then one is who's in front of me right now, who's in my office right now. And so one of the things that happened, for example, and this used to happen a lot when I was in banking and after being in banking, is you'd have a whole team of people going into, whether it's the DOD or whether it's a senator's office, just totally touting the thing that they care about most. And it's not even necessarily the thing that's most important at that moment, but it will gain priority because ultimately, it's the squeaky wheel of capital that tends to just get in front of government. Now, government moves much more slowly, strategically, than capital can move. But at the same time, it can make the wrong decisions or make the late decisions based on what's in front of it. And I think that is something that that's happening. That's actually happening with uranium this year. It's kind of been a byproduct of critical minerals and antimony and other things, which are concerns at parties or are concerns in anyone's senator's office. So that's one of the things that I also see happening with respect to the nature of the scarcity of certain hard asset supply, where there's also that opportunity to look at where there is the most scarcity. And that tends to get the fear up in terms of Washington and in terms of getting those meetings and in terms of getting some funding into those companies, like we saw with MP Materials and USA Rare Earths, because it's in front of Washington at that moment and it seems important at that moment. The opportunity is to look at where the capital is going. Not necessarily make decisions because Washington did something, but to recognize that once it does make a decision, lots of meetings and lots of things have happened to get that funding decision to be made and that capital to flow. And generally there are Wall Street companies involved in some part of that deal. And generally the market will become aware of that. And as investors, that is an important component of what to watch for. And it can also work the other way, but it's very important to note that there's a whole capital chain that goes through the government, through private companies, and into the hard asset space. And we look at all of that capital flow as well as what's happening on the macro and geopolitical level, because ultimately it does impact at the end of the day share prices, and it does impact not how good a company is run, because some of these companies are not run very well that get the most money. That's not a one-to-one correlation. That's where the extra homework goes in, the extra learning about the company, the experience, the management team, the projects. But if you can marry those two from a learning perspective, you can actually make more money.
All right, we'll go to Grant or Adrian. Do you think, are you on board with Adam here on there? Do you think that this is perhaps ambitious?
Well, a couple of things. I mean, I would think if orgies are your thing, then going to an orgy is wonderful. But I would think on the flip side of that, unexpectedly finding yourself in the middle of one would be absolutely horrendous. So this whole idea of capex,
I knew I'd regret that.
Whatever it may be.
You did bring it up.
You did open the door.
Yeah, this is on you, Albert. But seriously, talking about this, the government and their influence on this thing, I think the big picture is we need to realize that the government, not just the United States government, but the EU and the UK and Australia and Canada, all these countries, all these Western democracies are in the same boat, where we're moving into a period where the governments are going to start to need to do things, right? They're going to have to need to do things. And that's probably going to be incredibly positive for the commodity sector, ironically, because they're going to have to bend rules because they need the stuff out of the ground. So all the problems we've had with permitting, all the environmental stuff, when the government needs to do things, they will find ways around it, right? So on the
Talking about the government taking a share in Amazon, Alphabet, Meta.
Maybe. I mean, maybe. But I'm talking about the hard resources now. Right. There are going to be rules that, permits that people are saying, well, we're never going to get this permit through, that magically come through now because the government needs it. And there may be a deal where we're going to take 20% of
the
what
permitting
you put
they
out
can
the
do,
ground.
but what about the money?
All that stuff, right? But on the flip side of that, need environment, they're also going to need to find buyers for treasuries. They're also going to need to make sure pension funds have a certain amount of treasuries. So ironically, there could be some very good, strong benefits for the commodity sector in this age of need, but as you get that one hand patting you on the back from the government, you've got to watch out for the other hand reaching into your back pocket, because they're going to be forced to do that.
Adrian.
I'm not talking about anyone on this stage, but frankly, I am staggered at how erstwhile free market proponents are either complacent or actually applauding the fact that the government wants to invest in private companies. I think this is an absolute, I mean, this is what fascism is, right? I think it's an absolute disaster. Now, the government speeding up permitting, that is wonderful. But the government's taking direct equity stakes in private companies in order to help you out somewhere, I think this is just unbelievably appalling, not just on a theoretical basis, but it is going to come back to bite those companies. If a company I own said, good news, Trump has just decided to take 15% equity in that company, I would sell immediately. If the government came to me, they're not going to do it, but if they came to me and said, hey, Adrian, we'll give you $20 million for your money management service for a 10% stake, I would say, no, thank you. If you want to abolish the SEC and just get out of my way, that would be fine. But a stake in my company, absolutely not.
Anyone want to agree with that or counter that?
Yeah, no, I think he's absolutely right, but doesn't mean it's not going to happen. Right, and that's the danger here, because they need to do this stuff. It's not that it's a great idea. I'm sure the government don't want to be in the mining industry, for example, right? It's the last thing they want to be in. But if they think that's the solution to their problem, the problem on the other side is intractable. We all know what the problem is. There's no other way around it. So I share everything you said, right? But I still don't think you can sit back and go, because it's a terrible idea, it's not going to be something we have to deal with. That's the issue.
This is great. You know, we should have got Adrian mad earlier. This is great. The flip side of that is how is the U.S. supposed to compete with other countries that are doing that?
Oh, you're asking me?
Yeah, or anyone.
I mean, certainly. Well, first of all, if you believe in, if you believe in a global free market economy, you don't have to be, and you believe in what Adam Smith and Ricardo said about competitive advantage, you don't actually have to have every single industry. Britain does not have to have a shipbuilding industry. The US does not have to have a steel industry. You don't have to be involved in every single industry out there.
What about in a fragmented world economy, though, where supply chains are being sort of protected?
Well, you have to have more than one source. Of course you do. I just think we're going in the broad wrong direction. So, I mean, if you have the government of Canada saying to Agnico, you know, we really would like you, since you're such a strong Canadian company, to look for and invest in strategic critical metals that we as a nation need, and we're going to speed up the permitting in order for you to do it, that's one thing. No problem.
Nomi, this falls within your expertise. What are your thoughts on this?
Well, I think it is a strategic decision. I would not want the government to be a miner or to be a geologist or to be an engineer in a project, again, for which there is an experienced team in a company where it's running, where the exploration's happening, where there's product being produced. I think the reason that we've gone down this slope, and it's still important to watch where the capital is coming from and going to, is because, for example, in rare earths, the government decided they had been making a mistake for decades, not understanding what they wanted and where strategically they wanted to have a role. And then they were like, oh, wait, we have no control over what goes into any of our strategic defense weaponry. What do we do? Now, is putting 15% of a government stake, which is also $1.1 billion deal with Goldman Sachs involved and with JP Morgan involved. So, you know, you got Wall Street, you got the government. You don't want any of them to run a mine. I mean, I'm on the board of a mining company. I don't want a bank to run the mine. I don't want the government to run the mine. But in terms of the funding, when you get to a point where there's a ultimate disconnect between years of not figuring out what you want your policy to be, and then being so far behind, the choice is, fall more behind or do something. And I think an equity investment is a dangerous thing, but I will follow where that capital goes to see what MP does with it. But on the same token, I think that other nations have put a lot more focus on how to develop their supply chains in a way that we have fallen so far behind in, that it's helpful to at least rethink where we can capitalize, at least to remain, not even remain competitive, to be at the table of the competition. So then you get the free market to sort of take its move, as opposed to being behind your policy versus what you need basically to supply your defense or your security or your energy policies.
All right, we're technically out of time, but I want to give Adam the last word.
Well, I just wanted to add one quick thing to what Grant said, which is, I don't know how many people in the room are familiar with the energy analyst Doomberg, but in talking about governments exploiting or making it easier to take advantage of deposits than they have in the past, he has a little quip that has always stuck with me, which is, it is far easier to remove a political constraint than a geological one. And I think we're going to see a lot of that going forward, where previous places that were off limits are, boom, they're suddenly open for business.
All right, we're out of time. Thank you very much, guys. Please give a round of applause to our panelists.